Ever notice how some financial shifts just kind of creep up on you? For a while now, well, we've been seeing these headlines, right? Companies not just dabbling in crypto, but actually weaving it into their core treasury strategies.
Yeah, Michael Saylor and MicroStrategy, they really made waves with that. Showed everyone a whole new playbook using Bitcoin.
Absolutely. A big deal. But here's where it gets, well, maybe less talked about, but really interesting. Companies are starting to look at doing something similar, but with Ether.
It's a fascinating next step, isn't it? Because while Bitcoin, set that precedent as digital gold,
Yeah.
a store of value, Ether brings something else to the table, something more maybe dynamic, productive even.
Exactly. Productive. And that's precisely what we're going to dive into today. We're working off some really illuminating bits from a Bloomberg television interview with Joe Lubin, co-founder of Ethereum.
A key voice in the space, for sure.
Right. So our mission here in this deep dive is pretty clear. We want to unpack the key differences, Bitcoin versus Ether for these corporate strategies. We want to explore why Lubin feels Ethereum's future is now.
And what that actually means for the wider economy, for digital trust, all that stuff.
Yeah. Think of this as like your shortcut to getting your head around this whole evolving picture, cutting through the noise. So let's get into it. So, okay, let's start with that core idea Lubin brings up. Ether being, well, productive for corporate treasuries. We know Saylor did, as Lubin put it, a brilliant job with Bitcoin at MicroStrategy, put it on the map. But what's fundamentally different with Ether?
Well, the key thing, the big differentiator Lubin points to, is describing Ether as a productive and yielding asset. That's the core. Bitcoin is mostly seen as, digital gold. It just sits there, hopefully appreciating.
Right, a store of value.
Exactly. But Ether, it has these built-in ways to potentially grow your holdings, to generate actual returns on the Ether itself. That's a pretty powerful edge if you're managing a company's treasury.
Okay, yeah, that is a big difference. So how does that work in practice? How are companies actually making Ether, productive? Got any examples?
Sure. So Lubin mentions companies like Sharplane Gaming. He actually chairs that one. And also Mind Emerging, Bit Digital.
Yeah.
They're all accumulating Ether.
Okay.
And Sharplane Gaming's approach is quite interesting. They apparently gather capital daily, things like ATM facilities, other ways, convert it straight into Ether. And then this is the key part. They're instantly staking it.
Instantly staking. So for listeners, that means locking it up to help run the network and earning more Ether.
That's basically it.
Wow.
Or they're using what Lubin calls decentralized finance yielding capabilities. Think of it as using smart contracts, DeFi protocols, to earn returns on their crypto holdings.
So they're not just buying and holding, they're immediately putting that Ether to work, making it sweat, basically.
Right.
What's the big strategic goal behind doing it that way so actively?
Well, their thinking, according to Lubin, is that this lets them accumulate more Ether per fully diluted share much faster. Faster than other Ethereum projects, he says, and definitely faster than the Bitcoin strategies.
Ah, okay. So it's about increasing that Ether holding relative to the company's ownership faster than just buying and waiting.
Precisely. Leveraging Ether's own features for growth, not just relying on the price going up. It's about maximizing value for shareholders through that active management.
Makes a lot of sense from a corporate finance perspective. Now, this always comes up, right? Leverage and risk, especially with crypto's volatility. When companies pile into an asset like this, you got asked about leverage. What's Sharplane Gaming doing there?
So at the time of the interview, Lubin was clear. They were not levered at all. Zero leverage.
Okay, that's conservative.
Yeah, but he did mention they are considering offering convertibles.
Convertible, so bonds that can turn into stock later.
Exactly. And that would involve, as he put it, some leverage. So it's on the table, maybe, for the future. But they seem very focused on being careful.
How do they plan to manage that then, if they do introduce some leverage given how much crypto prices can swing?
He really stressed keeping leverage very much in check.
Yeah.
Maintaining a pretty low risk profile. It sounds like they want to be cautious.
So why be cautious if they're so bullish on Ether?
Well, that caution seems tied to their strong belief in the long game. They think decentralization is going to grow dramatically over time. They expect extreme appreciation of Ether and Bitcoin and some other tokens.
Ah, so the idea is the underlying asset is expected to do so well long term. You don't need to take huge risks with leverage.
That seems to be the thinking. Be prudent with risk now, and the shareholders will benefit hugely from the core asset appreciation later. It's a patient strategy, really.
Okay, that leads us nicely into this quite bold claim Lubin makes, this whole narrative shift. why Ethereum's time is now. Bitcoin got here first, yeah, 5, 6 years earlier. Its value proposition, that digital gold thing, hedging against currency issues. That's been clearer for longer.
Right. Bitcoin's value was always kind of now.
But Lubin argues Ethereum's moment, its future, which always seemed ahead, is actually here, right now.
He does. He says it's become increasingly clear that Ethereum's future is now. He's not alone, right? You hear analysts like Tom Lee saying things like, the next Bitcoin is Ether and Ethereum.
That's a big statement. So what's the fundamental reason for this shift beyond Ether being productive? Why now for Ethereum?
The core reason, as Lubin explains it, seems to be this growing recognition in finance, in big companies, across markets, that the whole nature of trust is changing. And it's changing because of these decentralized protocols.
Okay, the nature of trust.
Yeah.
How does Ethereum enable that differently than Bitcoin?
Well, Ethereum lets you, as Lubin phrases it, bring programs to Ethereum. It's not just about sending value. You can build complex applications, create agreements, interact directly without needing the old middlemen. Bitcoin doesn't really do that in the same way.
Right, so it's more programmable, more flexible. And what are the actual benefits of using Ether on this platform, this trustware, as some people call it?
You get things like guaranteed execution, verifiability, the ability to set up agreements that are automatically enforceable and do it very easily and inexpensively. It just cuts out so much friction and cost associated with traditional trust mechanisms like lawyers or escrow services for everything.
So it fundamentally changes how we can make deals or transact online.
That's the idea. And the economic impact, in Lubin's view, could be massive. He believes this new kind of trust, with Ether as the sort of highest grade trust commodity powering it, could enable the economy to grow much larger and much more rapidly.
Wow. Okay. A pretty grand vision there. Let's shift gears slightly to regulation and how profitable this industry actually is. Lubin had some interesting takes on the SEC. How does he see their stance on this tech? Supportive, skeptical?
From his perspective, he sees the SEC as very clearly supportive of decentralized protocol technology, which might surprise some people.
Yeah, you hear different things. Who does he point to?
He mentions people like Commissioner Hester Pierce, calls her a great advocate with well-thought-through warnings, and Paul Atkins, another former commissioner, who apparently said very positive things about the direction of our technology.
Okay, but what about things like, the Bitwise ETF thing? They approved it, then kind of reversed course on converting it. Doesn't that suggest uncertainty?
Lubin seems to frame those kinds of incidents as mere technicalities, not fundamental opposition or deep uncertainty about the tech itself.
Interesting perspective.
And he goes further, actually. He makes this claim that it's now legal to use and build on blockchain in the United States, which he contrasts with what he calls serious regulatory headwinds under the previous leadership at the SEC. So he sees the current environment as much clearer, much more positive.
Right. That clarity would be crucial for businesses. Now, on profitability, you always hear this debate, right? Crypto prices might boom, but are the underlying businesses actually making money? Is the ecosystem growing profitably? What's Lubin's take?
He pushes back on that skepticism pretty hard. He insists there are some very profitable businesses and even some very profitable protocols already within the Ethereum ecosystem.
Profitable protocols, you mean like the infrastructure itself generating revenue?
Yeah, through fees or other mechanisms built into the protocols. And he connects this to Ether's performance, noting the token's doing quite well recently because the network is now scalable enough, affordable enough, usable enough for these businesses and protocols to actually work and, well, make money.
So the tech has matured enough to support real business.
That seems to be his point. And he finishes with a really bold prediction. Profitability in our ecosystem is about to be rampant.
Rampant profitability. Okay, so let's bring this back to you, listening. What does all this mean? We've heard how Ether isn't just being held like a digital gold. It's being used as a productive, yielding asset in corporate treasuries, potentially accumulating faster per share.
And maybe even more fundamentally, we've explored this idea that decentralized trust protocols like Ethereum are changing the game for agreements, for transactions, maybe even for economic growth, paving the way for that rampant profitability Lubin predicts.
Right. This shift towards trustware, this potential for new economic models, It really makes you think, doesn't it? It raises a question for you to mull over.
Yeah, thinking about your own digital life.
Yeah.
Given this landscape, what parts of how you interact online, how you transact, how you maybe verify information, how you deal with institutions, what might be next in line for this kind of revolution?
And what questions does that bring up for you about your data, your interactions, maybe even how you could participate in whatever comes next? Something to think about.